All right, welcome to my channel, everybody. This is Jason Allen John, and here's where we're going to focus on mortgage rules, mortgage information, stuff about the Canadian economy, anything that kind of moves the real estate market, especially on the finance side. My name is Jason Allen John, and I'm a mortgage broker for Integrity Tree Financial Solutions out of here in Toronto. And I'm really focused on assisting homeowners in getting the best mortgage possible for their needs. I'm looking forward that you're going to come along with me with the journey. We're going to post a lot of videos. We're going to have a lot of stuff active, and we're going to get into this. So this first topic that we're going to focus on is just, the big thing in the room that everybody talks about all the time when it comes to real estate is interest rates. What do I do? Fixed, variable, what does it mean? Where are we heading? And I'm going to mainly focus on where we heading. So let's head into it. So again, this is me. This is Jason Allen John. We're here, and let's just do a quick introduction. So we're going to talk about some historical data when it comes to factors that influence the Canadian interest rates and how that impacts the housing market. And we're also going to just talk about, different type of mortgage availability when it comes to interest rates, just the small amounts like variable, fixed, how the rates change based on Bank of Canada policies or essentially the bond rates. And we're also just going to talk about some historical rates since the pandemic. And, we've recently seen an upward trend in interest rates. They were kind of going on a downward trend, but it's kind of stalled out. So we're kind of have leveled it out. And we're going to just talk about what we think or what a lot of people are predicting, what they feel about the future. And then we're going to see where the shift in the Bank of Canada's policy is going to be. Over the last few months, they've been cutting aggressively, 50 basis points a couple of times. And now I think we're going to head down to a slow period, but we're still going to see a decrease in interest rates throughout 2025. However, a lot of factors can change over time. So several forecasts indicate that we're going to see a decrease in interest rates. So I think what we're going to see is you're going to see 4.5, 3.9, maybe 3.5 to 5% interest rates throughout the year, depending on what's going on, which is going to be good because there's a lot of people that are up for renewals. So these decrease in interest rates are going to do very well for them. Now, we're going to see a resurgence in variable rate mortgages. And the reason is because more than likely, you're going to see that the variable rate is going to be less than the fixed rate. Now, I do think that individuals look at variable at this moment just because of all the different things that are going on, the rates and the different flexibilities. However, you do got to pay attention to what happens because they could rise again. And if they rise again, you don't want to get caught up in that storm. So I think it's very careful to analyze each individual situation when you're determining if you're going to go a fixed or a variable rate. Now, there's going to be a lot of intense competition between the banks and the lenders. So you're going to see a lot of rate promotions. And also, please don't get fooled with like the headline rates, because a lot of the headline rates that you see are insured rates. So if you're not really purchasing, or as you're going to see in later videos that we're going to do, refinancing to build accessory dwelling units, those rates most likely don't apply for you. Now, they may apply for you on some renewals because some of you are going to have renewals, so you're going to be able to switch to new lenders. However, typically a lot of people are in conventional, and that's not the conventional rates. Now, as of right now, as of January 6th, the Bank of Canada's policy and prime overnight rate stands at 3.25%. And prime rate right now is 5.25%. So prime rate is basically the best rate that is offered by most financial institutions. Now, what is going to be the forecast for the Bank of Canada rate? So what we're looking at is we're looking at this at January. They're going to meet January 29th. That's going to be around 3.25. They're going to go down 25 basis points. And then March stays stable, potentially go down in June, and then stay stable in September and kind of ride that way. So we're probably looking just a 50 basis point cut from where we are today. Now, this is some forecasts, as you can see, and you can see how these rates are going to differ and how things are going to be. So the 5-year fixed rate I was talking about earlier is probably going to be around that 4.1 to 4.2%. depending on the timing. 2-year fixed rates are always going to be a little bit higher. And again, if you look at it, the variable rates, we're talking about between 4.3 down to 3.8. So some individuals will kind of sit there and say, hey, you know what? The variable's for me. I'd rather take that break in that rate and deal with the variable. And then, if Bank of Canada does raise rates, I'm going to keep my eye on it because then maybe I'll lock into a fixed rate at that time. So this is kind of like some of the projections that we're seeing in the market going forward for the interest rates. Now, historically, interest rates over the last 20 years has hovered in between 3%. Obviously, during the pandemic, we saw as low as like 0.99, but typically 3.5 to 4%. I remember when I first got into the mortgage game, my interest rate or the interest rates were like hovering around like 4.5%. And then mortgage rates have declined significantly since the 80s, where rates were hovering around 20, 28, 25. I think they got as high as 30%. However, now, obviously, things are different. However, what's to offset those high interest rates, the home prices have risen so much as we've seen over the years. So it's like at the end of the day, everybody's going to be paying the same amount. So if the interest rates go down, housing prices go up. If interest rates go up, housing prices may come down as we see. So it's just a balance and what essentially Canadians can afford to play. Now, the downturn trend is still long term. Now, we have some, obviously, and I'm going to show you a bond chart. We have seen some uptick in the rates, but the trend line over the time period is still downturn. Now, what are the stuff that affects the Bank of Canada's rate? So, or affects interest rates, I should say. Well, the Bank of Canada interest rate policy. So the Bank of Canada interest rate policy, they meet several times during the year. So the next meeting is going to be January 29th, as we can see here. And then they're going to be in March, as you can see, April 16th, June 4th, July 30th, September 17th, October 29th, and December 10th. So those are all the key dates that we have to watch out for the announcements that Bank of Canada is going to make and how we can follow up and determine what decisions we're going to make through our time period. During that time period, the good thing is they also, what they say here, issue a monetary policy report. And this report kind of gives their opinion on what they think about the market at the time. And obviously in future videos, we'll delve deeper into this stuff. Now, the other stuff that affects the interest rates is the U.S. interest rate policy. We're very directly connected to our partners to our south. Our dollars are intertwined. As you can see, the Canadian dollar has been falling. And it's kind of related to because our interest rates are much lower than theirs. So their economy is deemed at this point to be a lot stronger than ours. And, they're a lot bigger country and they set our policy in a way we kind of follow them. We do have some interdependence, as you can see. We're not dropping, like we're much lower than them. But having said that, we do follow what they do. Now, the bond yields also play a big part, domestic and international. So you'll see our bond yields kind of move up and down with what's going on with the market. So you can see here, this is kind of the bond chart over the last, let's extend this out. We'll just say this. We'll just do this over the last 5 years. So you can see down here, this was the low. We're looking at 0.49%. This was the depths of the pandemic. So we've risen quite a bit, about 3%. We've risen about 3% over the last 3 or 4 years, and you can see we've kind of just maintained this bit over here. So as you can see, I'll just kind of come in here a little bit. Let me move myself, and you could see that we've kind of just hovered in between these rates. So right now we're at about a 3.4%, and we've gone to basically a low of about 2.8 over the last, let's call it 2.5 years. So I see us kind of floating in this range going forward. I can't see us coming out of it or changing it very much. Other things that affect our policy and affect our interest rates are economic conditions. So job market, are people working? How are people spending? How are the retail sales? Inflation, inflation's been a big topic over the last few years. Inflation's kind of on a downward trend now. So we got to pay attention to all those things when we're making decisions when it comes to housing. And then there's going to be a lot of competition among lenders. There's a lot of lenders in the market. as a mortgage broker, we have a choice of over 60 lenders, banks, monoline lenders, B lenders. So rates are, private lenders, rates can go right now as low as, 4.1%, and you're talking up to 10, 12%, depending on what you're looking for and what your product is. But however, that it really, really depends on the situation that you're in, and rates are very sensitive to what is going on in the market. So the impact of the interest rates is increase affordability. When interest rates lower, it increases affordability, especially if prices don't rise in the same way. The other thing that's very important that we're gonna see next is like we're in the renewal period. So let's talk about that. Let's hear about news about the renewal period. Just gonna go to the story that's on.
Dave Steele is playing the waiting game with his mortgage, holding out on his renewal as long as he can, hoping the interest rate drops by the time he has to sign a new agreement.
But if I can wait as long as possible to execute that plan, if that's going to help me, because if the rates continue to go down, I want the best rate I can.
His mortgage deadline is in August. Inevitably, he knows it'll cost him more with interest rates.
So as we talked about, he says his mortgage deadline is in August. So we have a couple, I think we got like a 5 or 6 Bank of Canada meetings before that time. So he's right. He wants to see if rates are going to go down. But as I said, with the forecast, we may not know what's going to be the depth. So it's good that he's paying attention.
Where they are.
And I know the rate I'm getting right now is in the low 2s, and I know I'm not going to get that.
But he's not the only one facing the financial squeeze. Across the country, there are 1.2 million mortgages up for renewal this year. According to the Canada Mortgage and Housing Corporation, 85% of those mortgage agreements were contracted when the Bank of Canada interest rate was at or below 1%. Right now, that key interest rate sits at 3.25%. It did sit at 5% this time last year. Steele, usually a 5-year fixed rate guy, is now considering a shorter term.
Now I'm willing to try things a little different.
Like many Canadians, he's betting on a shorter term mortgage with the hopes the interest rate will eventually find its way back down, closer to that 1% mark.
Everybody's situation is a little bit different. I can tell you a variable rate mortgage is certainly more popular than it was a couple of months ago. I would say one of the most popular mortgage products that we're doing right now is a 3-year fixed.
Halifax-based mortgage broker Clinton Wilkins anticipates a gradual cooling off of the interest rate as the Bank of Canada slowly eases that overnight rate.
I think the renewal landscape is more optimistic than it was maybe in 2024.
And I agree with that because like things are kind of opening up for people. So like last year, if you had like a 2% rate, you may be looking at like almost close to 6% that you're renewing. So that's almost like a 3x in some cases, like that gentleman that we just witnessed on the video. But things are kind of changing. So, this is what I'm saying. It's good to pay attention to all the factors that determine what happens with our interest rates.
We saw a lot of rate decreases already, and I think things are more stable now than they were maybe last year.
Wilkins' best advice is just that, to seek advice from a mortgage professional. Meanwhile, the Bank of Canada is expected to revisit the key interest rate at the end of January. It's hard to predict if that interest rate will come down again, but that's what many here are hoping for. Todd.
No doubt. Jesse in the Halifax studio.
So obviously all of us are hoping that interest rates kind of go down a little bit, so it can kind of cushion some of the blows of the people that are going to be renewing. And I'm here for any advice. If anybody want to contact me, my link will be in the description below. You can book a call with me, or we can do a mortgage application to talk about your situation, what's happening next, and where rates are going and how it could potentially affect you. So other things is going to stimulate the market if rates go down. Also, there's a lot of programs and products that have come out that I think could stimulate the market, but they're all factors that I think there's a lot of buyers that have left the market, like investors and other individuals, foreign buyers and stuff. But I think they may come back because of the dollar. So there are some stuff. And then there's some potential, I feel, for some price increase. Very moderate, not all across the board. Obviously, the condo market is experiencing some increased supply, which has decreased the demand. A lot of those are investor units, and then we have all those issues with immigration and a bunch of stuff, and we can kind of go on and on. But again, we'll save that for other topics and stuff that when we get into it. But I just want to focus on the impact of the interest rates and how it affects the everyday Canadian citizen, and especially all of those, 1.4 to 1.5 individuals that are renewing in the next 12 months. It's very important to pay attention to those topics. And thank you. Please subscribe below, and we'll talk later in the next video.